Hi all, this is Dr. R. Gayatri, Head Department of Commerce, Banking and Insurance. In this video, let's see the issue of shares and the journal entries related to it. There are various stages of collecting share capital. The first and foremost stage is a share application in which the company will invite the public to apply for the share. They will fix one fees for that, and that price should not be less than 5% of the original value of the share. The next stage is share allotment. It is the acceptance of offer made by the applicant to purchase the share. On the receipt of the allotment money, the company will issue share certificate under its common seal to the shareholders. Next is calls. The balance due on the shares may be called by the company in installments. Each installment is called calls, and there should be at least a time gap of 1 month between each calls. The call amount should not exceed 25% of the face value of the share. There should not be more than 3 calls. Next is forfeiture of shares. If any shareholders is failing to pay any of the share capital amount, new due notice will be given to him, and after that the company will decide to take back the shares allotted for him. This process is called forfeiture of shares. Next is journal entries. First one is share application. The first stage is the public will be paying the share application money and they will applying for the shares. So initially the company is receiving the application money through the bank account. So bank account is debited against to share application account. Narration will be paying share application money received. The money received will be transferred to the share capital account. So share application is debited against the share capital. So share application account data to share capital. Narration will be being share money transferred. If the company directors decide to reject and refund any shares, then there will be a reverse entry. That is, they are going to pay out the money they received through their bank. So, application account data to bank account. Next is the allotment stage where the company have to decide what type of allotment they are going to do. There is two types of subscription. One is under and one is over subscription. If the application received less than the issued application, it is called under subscription. There the company will decide to allot for the all application. If the application received are more than the number of application issued, it is called oversubscription. In that case, the directors may either totally reject excess application or allot on pro rata basis. Pro rata basis is nothing but the excess application money received will be adjusted towards the allotment and call money due from the shareholders. The journal entry for this will be share application account data to share allotment, that is excess application amount is transferred to the share allotment account. During share allotment, again the directors have to decide whether they are going to issue the shares at their par value, that is their face value, or at a premium or at a discount. For example, let's have the share price at 10 rupees. If the company decide to issue the share at 10 rupees itself, it is called issuing at par. So the share allotment account data to share capital is a due entry. Then when the shareholders pay the allotment money, they'll receive the cash through the bank account. So bank account data to share allotment account being share allotment money received. If the shares are issued at premium, that is the 10 rupees shares are issued at 12 rupees. That 2 rupees is the premium amount the company enjoys for their reputation, goodwill, or earning more profit. So it is a income for the company. So share premium is credited against share allotment. Share allotment account data to share capital account to share premium account, being allotment money due. The same amount will be received, so bank account data to share allotment account. If the company decide to issue shares at discount, that is, the share face value is 10 rupees, but the company is deciding to sell it as 8 rupees or at 9 rupees, the balance 1 or 2 rupee will be the loss for the company, so that loss is debited as share discount against the share capital account. So share allotment account data you have to show 8 rupees or 9 rupees. Share discount account data 2 rupees as a loss to share capital 10 rupees. Bank account data to share allotment account. The company will receive the amount debited against share allotment, that is 8 rupees or 9 rupees, because the company have issued at the discount, so the shareholders will not pay the discount price. So bank account data to share allotment account. The next stage is call money. Share first call account data to share capital account. This is a due entry. When the shareholders are paying this amount, the entry will be bank account data to share first call account. This procedure will be followed for the subsequent calls up to the third call. Thank you.